So let's dig into the economy. Will these curveballs, quote unquote, strike out the economy? There's no doubt that over the last 6 months, the level of anxiety in the headlines coming out of the news outlets has just gone higher and higher and higher. And so we're often getting questions from our clients, does all this matter? Is this going to have an impact on the economy? Obviously, these headlines are so severe, they have to pull back the economy at some point. So whether we're talking about trade wars, or trouble with Iran, the North Korea issue, which is on again, off again. There's Brexit, which is actually officially happening. Latin America, whatever the case is, the headlines seem to be the bark, but they're not the bite. So let's dig into the actual numbers and let's look at why we still believe the economy is strong and is going to continue to be strong. Starting with these trade wars. So what we know is that the president, Donald Trump, has decided he is going to take a stand in terms of how we negotiate trade deals around the world. It's scary. We're hearing these big numbers, billions of dollars of products will be tariffed. And then China retorts and says, well, we're going to put tariffs on your products, and we go back and forth. But the reality is, as we look at the numbers, it has not yet affected the economy or the momentum of the economy. So this chart shows small business confidence and CEO confidence. And what we'll see is even though the trade wars rhetoric has kicked up, confidence has continued to rise. And so we're at extraordinarily high numbers. It looks like confidence is high. And what we know is when CEO confidence is high, when small business confidence is high, that means that the economy still has more room to run because these are the decision makers in the vast majority of businesses. Leading indicators in the market continue to point towards expansion. And so as we can see on this next chart, we're still at higher levels. Actually, since the trade war rhetoric has started, leading indicators have continued to improve. So there's nothing here in terms of forward-leading looks that says to us that this thing's rolling over as a result. Again, I would caution folks when you look at these headlines, the dollar amounts that we're talking about in terms of tariffs are actually quite small relative to the size of our GDP, our economy. And so, yes, there is the potential this thing can escalate and it can continue to build, but as of today, there's just not enough there to cause this to slow down. Looking at the consumer continues to be very strong in this economy, in fact, powerhouse. And what we know is that not only are they strong mentally, but from a balance sheet perspective, they continue to get stronger. So the first chart on this page shows the consumer is actually working and that the job prospects for the consumer actually look quite good. The orange line shows this unemployment rate, which continues to go down. We're under 5% is full employment. We're now under 4%. Now, the latest jobs report just put us back at 4%, but still a remarkably strong labor market. And the dark line shows the U.S. quits rate. In other words, are people voluntarily leaving their job? And so that is happening less and less and less. So what we know is people are actually coming back to the market. The latest jobs report showed a very high number of people coming back to the labor market, and yet the labor market still is extremely tight. Broad-based consumer confidence is very high. We talked about small CEO confidence. We talked about small business confidence. And here we can see the consumer also continues to be confident in the face of all these headlines. And that confidence level continues to rise and continues to gain momentum. Consumer balance sheets are very healthy. The third chart shows that the household net worth for consumers since 1980 has just gone straight up, other than that obviously significant hiccup in the Great Recession in 2009, or late 2008 and early 2009. However, it's fully recovered. But more importantly, and I think very interestingly, if we look at the dark line, we see that household debt service ratio, or a measure of how leveraged is that consumer, that leverage ratio has come down considerably. So leverage was going up and up and up. We know the stories about people taking 100% mortgages and then adding on home equity loans, and they were just completely underwater. Then we had the Great Recession. That really has put the fear in the consumer. The leverage has started to come out of the market. And so balance sheets, net worth is up, leverage is down. Very good for the consumer's ability to spend. The final chart shows that consumers are getting back their equity from the crisis. And in fact, we are now at levels we saw 2005, which was the peak of this housing boom. And so we had this great drop in homeowner value. We've come back. And so once again, from a consumer perspective, each aspect, confidence, labor, the ability to buy, and the purchasing power to purchase, as well as what we all count on, the value of our home has been restored. So we think that the consumer is going to remain very strong. Manufacturing, that continues to point to an acceleration. So we are seeing improved numbers. CapEx spending looks like it's starting to gain some momentum. Manufacturing numbers are positive. Again, another green light, another point positive for the economy. And interestingly, since the tax break, we are also seeing a spike in the repatriation of dollars. So what that means is corporations who do business overseas, they have tended not to bring those dollars or those currencies back to the U.S. because of tax. They know that if they bring those back, they'll be taxed. So in this new tax bill, there's a very favorable treatment for corporations to bring money back here and inject it back into our economy. And as you'll see in this chart, that number is spiking. The last time we saw it spike was the last time that the government gave a holiday for those repatriated dollars. This spike is unlike anything we've seen in the past. So once again, those dollars are coming in. They're going to reduce debt in corporate balance sheets. They're buying back stock, which helps shareholder pricing. And yes, they're going into capital expenditures to build out and grow companies. So we see a lot of good news across the board in the economy. I would say the one area of concern that we want to make sure we keep our eye on is inflation. We'll see on this next chart that inflation has been remarkably low over the last decade plus, but we are just now starting to break above a long-term trend line. In fact, this trend line goes back to the 1960s, and we've just broken the trend line. Now, that in of itself doesn't mean we're going to have runaway inflation like we did in the 80s with Paul Volcker, but it does say this is an aspect of the economy we need to take note of. We need to watch. We need to be very careful. There's a lot of money floating in the economy. More money's coming back into the U.S. The labor market is getting very tight, as we see on the next chart. We know that job openings are going up, and the number of U.S. unemployed is going down. What does that mean? That means we're getting ready for a tight labor market. We don't have enough people to fill the jobs that are now created from a stronger economy. Well, again, going back to what we said earlier about oil, when there's strong demand and low supply, price goes up. So there's strong demand for workers, there's low supply of workers, price has to go up. What is that price? Wages. And what is the number one contributor to inflation? Wages. So this is something we want to keep our eye on. It is something that can hit the economy very quickly, and the markets will react. Right now, it seems somewhat tame, but definitely worth watching.